Welcome to the Money RX for CRNAs podcast, where you go behind the scenes with host Brett Fellows, CFP, as he explores the unique opportunities and challenges facing certified registered nurse anesthetists along the path to financial independence. In each episode, Brett shares expert insights and actionable advice, equipping you with the tools you need to take control of your financial destiny and retire on your terms. And now, here's your host, Brett Fellows.
Welcome to the Money RX for CRNAs podcast. Thank you for joining us. I am your host, Brett Fellows, a certified financial planner with over 20 years experience in guiding CRNAs through the complexities of financial planning, tax strategies, and investment management. For those of you who have tuned in before, welcome back. And for anyone who is listening for the first time, this podcast is dedicated to helping certified registered nurse anesthetists achieve financial independence and ultimately retire on their own terms. So welcome. On today's Money RX for CRNAs episode, we're talking about retirement again, but specifically how planning for your retirement distributions is essential to maximizing your retirement income and fulfilling your goals for this new phase of your life. As always, thanks for joining us. Our primary audience is CRNAs around the age of 50, often married with children, and typically about 10 years away from retirement. You have worked hard, and now it's time to ensure that your money works hard for you. If you want to receive weekly updates with recaps of the show or resources that we mention on the show, as well as some exclusive content, sign up for our Friday Blitz email. And you can do that on our website, oakcapitaladvisor.com. That way, once a week, you'll get an email with a recap of everything and some of the links to the stuff we talk about. So I chose distributions specifically to talk about today from an email we received from a CRNA from our last solo episode, where I was talking about accumulating for retirement. CRNA's name was Colleen, and Colleen sent this question to us, which I want to share. She says, "Dear Brett, I've been saving, and now it's time to tap into those retirement dollars. I realize there are several things I should probably keep in mind as I get ready to leave my employer's paycheck behind, including the fact that I may have to withdraw some of that money whether I want to or not. So I have two questions that I'm hoping you'll help me with. Number one, what are the things to consider when planning for my retirement? And number two, what do I need to know about taking retirement distributions?" And so, Colleen, that is an awesome two-part question. And I thank you so much for sending that. And I took some time, and I think this is the best way I can probably explain it. And I'll break it up to answer your 2 points. So key point number one, you mentioned the things to consider when planning for your retirement. Well, that's specific to distributions. The best thing I would say is consider setting up a plan to withdraw money from your retirement accounts on a regular schedule. Now, this is actually a question I get a lot and something that tends to be on the mind of clients as they get closer to their final years of working as a CRNA. So this is not uncommon. But think of it like this. Think of like creating a steady paycheck for yourself in retirement. And it's frankly not as complicated as it may sound. There's something called a systematic withdrawal plan that might work for most. Now, a lot of people use what's known as the 4% rule as a starting point. Basically, you plan to withdraw 4% of your savings each year. And this helps you cover your expenses without burning through your money too quickly. And on top of that, you can adjust it for inflation, so you keep up with the rising costs that happen naturally. Now, this idea of a systematic withdrawal makes sense to most, but a question that does come up a lot about setting up a paycheck for yourself in retirement is, okay, but what if I don't actually need to touch my investment accounts right away? Should I just leave them alone? And that too is a great question, because here's where things get interesting. Even if you don't need the money, the IRS steps in with something called RMDs, required minimum distributions. Once you hit a certain age, they require you to start taking money out of your tax-advantaged accounts. Now, these are accounts like your traditional IRA or 401k or 403b, because you haven't paid taxes on those monies yet, even if you don't need it. This is where the government gets their piece of the pie back, because remember, they've given you tax breaks over the years while you're saving, but eventually they want their share of tax. As of 2023, thanks to the Secure 2.0 Act, you have to start, or you can wait to start taking RMDs until age 73. Now, I know all of that sounds like a lot, but if you plan for it, you can make sure everything is in place so you're still stretching your savings and getting the most out of your retirement monies. Speaking of age, Colleen, the other important thing to consider when planning your retirement is if you retire early, you might need to make your savings last longer, which could affect ultimately how much you take out each year from your withdrawal plan. Now, thinking about one's age and ultimately mortality, as you can imagine, that's probably not the most comfortable topic for many. But retirement planning is really about making sure that you have enough money to live the way you want to for as long as you need. So, how does one even start thinking about that? I would suggest start by considering your family. Think about how long your grandparents or other relatives lived. Also, obviously, look at your own health. Are you generally healthy? If you retire early, and you most probably will live a long time, you might need to stretch your savings over a longer period of time, which means you might have to adjust how much you can withdraw each year. And if someone retires early, they should also probably be more conservative with how much they take out each year too, right? So it's all about finding a balance. You want to enjoy your retirement, but you also want to make sure that your savings last as long as you do. So it's a bit of a guessing game, but being mindful of your health and your family history, frankly, as easy as that can really help guide your decisions. Now, Colleen, to your second point, what you need to know about your distributions. Well, taking money out in retirement can be exciting, but doing it wisely takes thoughtful planning. So let's take a closer look at the three most common sources of retirement income, the rules you'll want to follow, and the potential pitfalls to steer clear of. Now, like many things, there are times when exceptions to the rules apply. But before you rush into any decisions, I do want to say it's smart to check in with your financial or tax advisor always first. Okay, if you worked as a W-2 CRNA, your employer most oftenly will have offered you a 401k plan where you contributed probably pre-tax from your paycheck, and hopefully your employer chipped in some sort of match too. So I use the analogy, think of it like planting a garden. You have been nurturing your retirement nest egg with every paycheck, and hopefully you were able to max out those contributions and get the full match from your employer. You've got a nice pot of retirement savings ready to grow. But as I talked about earlier, there are some rules around when you can start digging from that garden. And don't forget, there will be taxes to think about. And if you dip in too soon, there could be penalties too. What do I mean by that? Well, the IRS will let you start taking money from your 401ks or IRAs once you hit the age of 59 and a half. So that is the first age I would suggest you think of. Now, technically, you can take it out earlier, but here's a story we have dealt with recently. A CRNA client named Sarah who was feeling burnt out and wanted to retire early. She decided to dip into her 401k before age 59 and a half. Unfortunately, she got hit with a 10% penalty on top of the taxes she owed. So this ultimately, even in that 1 year, paying the 10% is painful, yes, but more importantly, it takes a bigger bite out of her overall savings that she expected to use. So while it's tempting to access those funds early, it's usually best to wait until you're in the clear to avoid any unnecessary penalties. So age 59 and a half is your main priority. When Congress passed the Security 2.0 Act, which I just mentioned, what they did was they raised the age from required minimum distributions, RMDs, from 70 and a half to 73. That means once you hit that age, you need to start taking monies out of your IRAs based on a formula that factors in both of your age and the total amount you've saved across all of your pre-tax retirement accounts. Now, you've got a couple of options here. You could either, for your RMD, take a lump sum, or you could opt for a systematic withdrawal plan, hint, what I mentioned in the first point, that will spread the payments out over time. And again, I recommend chatting with your financial or tax advisor about the tax implications of each option. Also, take a look at your expenses for the given year. Ultimately, setting up regular payments might make your planning easier and less stressful. If you want to dive deeper into how the RMD formula works, check out the book, The New Retirement Savings Time Bomb by Ed Slott. Although the title doesn't sound it, it's a great resource that explains all the ins and outs of this process. The tax situation with traditional retirement plans is like taking a rain check on something. You've deferred the taxes until later. So you'll need to settle up when you start withdrawing the money in retirement. On the other hand, with a Roth 401k or a Roth IRA, it's more like paying for your ticket up front. You've already covered the taxes before putting that money in. So when it's time to enjoy your retirement, there's no tax bill waiting at the door. Speaking of Roth accounts, here's a little bonus. They're not subject to the RMD rules like traditional retirement accounts are. Now, you still need to wait until age 59 and a half to start pulling monies from Roths. And the account has to be at least 5 years old. But the best part? Again, you're never required to withdraw a dime if you don't want to from a Roth. So it's like having a hands-off savings stash that you can grow as long as you let it. But just remember, if you don't follow those two golden rules, your age and the account's age, there will be penalties. So patience really pays off when you're thinking about taking distributions from a Roth. Now, the third point we need to talk about is Social Security. Social Security is a source of income that many CRNA retirees count on, but it's deciding when to start taking it that's not always so straightforward. You can begin Social Security benefits as early as age 62, but keep in mind, if you do, your monthly payments will be permanently reduced. Your full retirement age, or FRA, which you can look up through the Social Security Administration, is when you're eligible for your full benefits. And for most people born after 1960, that's age 67 and a half. However, if you can hold off until you're age 70, which is the last time you can, or the longest you can delay your Social Security, you'll get an even bigger payout thanks to delayed retirement credits. So like anything else, it's all about finding the right balance between when you need the income and maximizing what you'll receive in the long run. Another CRNA story we have dealt with this year, we have a CRNA client named Lisa, and she, like many, was excited about retiring early, and she thought about starting her Social Security benefits at age 62 to supplement her income. She loved that idea of having that extra money right away. But when we sat down and ultimately looked at the numbers together, if she started at age 62, her payments from Social Security would be permanently lowered about 30% less than if she waited to age 67. So when we talked about her plans and goals, ultimately, Lisa decided to hold off until she reached her full retirement age to get the full benefit. And frankly, she was even tempted to wait until age 70 because the delayed retirement credits would have increased her monthly payments even more. But in the end, we found the right balance for her that worked for her lifestyle and her financial needs was the full retirement age. This decision allowed her to feel confident that she wouldn't outlive her money. And now she's enjoying her retirement and knowing she made the right choice for her future. And then with Social Security, we have to talk about taxes. Yes, taxes. Depending on your combined income, which is your adjusted gross income, plus any non-taxable interest, plus one half of your Social Security benefits, that's your combined income, you might find yourself with a tax bill. Now, it's important to keep this in mind when planning your income streams in retirement. If you're curious about how the combined income formula works, there's a great article from the Social Security Administration that breaks it down step by step. And I'll put a link to that article in the show notes. One thing you need to take away from this episode, especially when you're thinking about Social Security, is that when you turn it on, it will increase your taxable income most likely. So you have to revisit your tax calculations when you turn on Social Security if you're also taking distributions from your retirement accounts. So again, work with your tax advisor, work with a financial advisor to look at those and calculate those because taxes will be the largest bill we all pay. Those were two amazing questions, really great. And thank you so much for sending those. If anyone would like to ask me a financial question that I could potentially answer for you during an episode, please do not hesitate to send those along. You can contact us from the show notes, and I'll also give you our contact information before the end of the show. Okay, next. This is week 2 of Anesthesia Anecdotes, where I want to talk about some tips about how to be happy that I'm actually trying to do for myself that will hopefully resonate with you on a personal level. Because believe me, I know thinking about money and retirement can be a pretty heavy and stressful topic. I live it every day. So how are we with money really depends much more on how we behave than what we know. So I wanted to share with you for this episode, my past summer of 2024. This was the first summer that neither of our 2 daughters have come home at all. One had to spend the summer at their college and the other started work full-time as an ER nurse in Charlotte, North Carolina. So my wife and I found ourselves as true empty nesters, but for the first time in the summer, and we live in the Southeast. Hence, this is where the summer conversation's coming. In the Southeast, it gets oppressively hot. So our goal for the summer was to do some due diligence about thinking about our future. We frankly don't want to be in this heat Memorial Day through Labor Day. So where would we go? What would we do? And through lots of planning, I really found that I'd enjoyed this planning. We went to 2 trips in the North Carolina mountains. We went to Asheville for 3 or 4 days. And the other time we went to Highlands Cashiers, North Carolina. And what we found was that although we're not, at the end of the day, North Carolina mountain hikers, we really had a great time and we just loved the experience of doing something new. And frankly, after 18 years of marriage, I can't remember the last time we experienced something new together. The third place we went to was we rented a home up on Cape Cod in Massachusetts. And that was frankly, it was a great time. So that might be something that we revisit. So something to think about, something that I went into with some apprehension, didn't really know what I was doing, but we spent time again looking for possible places to be in the summer. And we didn't really find anything, but just the experience of doing that with my spouse and just finding new things once again, it was really invigorating. So I hope you get some takeaway from that. Thank you for taking the time to learn more about financial planning with us today on Money RX for CRNAs. If you know a CRNA who needs financial planning guidance and thinks this show would help them, click the share button and send it to them directly. Also, you can make sure that you continue to receive my content. Please click the subscribe button below. If you or a loved one need any help or guidance with regards to knowing how much you need to save for retirement, or if you're simply interested in learning more about my practice, please reach out by emailing me at brett@oakcapitaladvisor.com, or again, visiting our website at oakcapitaladvisor.com. And what's really cool is you can schedule a complimentary pre-op assessment where I can answer for you 3 of life's most important questions. Are you on track to reach your long-term goals? An example of that would be retirement or work optional. How can your tax bill be reduced? And how can your investments be improved? Join me for our next show where I'm interviewing Katie Niemeyer, a professional speaker and philanthropist, an entrepreneur and CRNA who relentlessly encourages others to overcome obstacles and reach new goals. This episode has a lot to cover and you won't want to miss it. So until next time, thanks for joining this episode of Money RX for CRNAs and have a great day.
This podcast is for informational and entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast does not engage in rendering legal, financial, or other professional services.